particular point. Okay, so this is optimal trade entry point. This is an optimal OTE, optimal trade entry point. And I told you that OTE is, in a bullish market, OTE is deep discount. You can clearly see the zone. You can see the zone. This is the zone. Okay, so there's something that you can save that printed. When the market dropped the OTE, it came surpassed by a week. You can clearly see it is surpassed. Excuse me. Okay, you can see that it surpassed the zone by a week and dropped below the zone. I told you that one of the institutional reference points of ICT is a rejection block, and it's an array, and in this particular case it's a discount array. So where is our rejection block? We draw our rejection block from the lowest point that the price reached, the lowest week, to the candle that closed lowest. In this particular case, that was our rejection block. Okay, we are in discount, meaning we should be looking for buys. Okay, a rejection block shows liquidity sweeps, how liquidity was swept. That's the story behind a rejection block. It shows rejection. Okay, so basically you can just now delete your OTE zone because you know where you are. Okay, and be ready to engage in the buying. You're not okay. You can wait for a change of character, or maybe a market structure shift, some call it, from the lower time frames, or you can just choose to engage after the formation of the rejection. Okay, so as you can see, who is that talking, please? Do you have a question? Okay, you can see the market after forming the rejection block. It rallied a bit, then reversed to the rejection block, and then rallied hard. And this was a very, very huge movement that around 950 pips movement. It was a huge, huge movement. Again, after drawing the rejection block from the 4 time frame, you could have even dived to the lower time frames, like maybe the 30 minutes time frame to validate the rejection block. Yeah, here. So the market rallied again. In 30 minutes, we never had a market structure shift, but this 15-minute time frame, 15-minute time frame, we had a break of structure, the first break of structure here, and then we had another break of structure here. So here, this is what I was telling you guys. Look here. The market came and rallied from this particular point to here. This basically is an impulse wave. Okay, now you are searching or looking for entries from the lower time frames. This is an impulse wave. So here you just come. You need to come and check for an inducement where you are induced. Okay, you check for an inducement. I'll show you another criteria. Now, I told you an inducement is the price action where a candle sweeps the previous candle. So from this particular point, so this our point of interest. Now we can delete this particular zone. We have already identified that we are on a higher time frame, a point of interest. And remember, yesterday I told you that lower time frames, their work is to facilitate or to deliver price to the higher time frame liquidity pools. That's the only work of the lower time frames. So it gave us a market structure shift the first time, and then here, after giving us a market structure shift, it dropped down here. Check here, it dropped down here, where by this particular week, a market structure shift, and then it dropped by this particular price action, this particular candle. I think it's you can see. Yeah. that it dropped by this particular candle, this particular drop. You can see very clear. You can just come and mark this particular candle, high and low. And I told you there's a sweep and a break. So this was a sweep of liquidity. So you just opt that you are not trading until that low is swept, that wick is swept. Okay. After it is swept, now the structures that will form after it is swept are valid trading zones. Why? They are valid because liquidity has already been collected, because this particular liquidity below this particular a week, that was liquidity. So you will opt to trade, or you trade after liquidity have already been collected. So when look here, the market after the sweep, it rallied a bit and then came here and swept. Where did the sweep happen? It actually happened here. This
Excuse me, sir. Kindly repeat that again, please.
which part?
Your part after market structure, after we mark your candle, then it sweeps down. Kindly repeat hapo kidogo tu.
Let me repeat. Let me remove everything first. I said that for a valid inducement or a valid um, pullback, the candle that comes, the candle that prints prior, that, what will I say now? A candle that sweeps the previous candle, or a sweep happens, and you note that there's a candle that went below the low of the previous candle. You just come and mark candle high and low, high and low. Whenever you note that after the candle printed, there's another candle that uh, went down, because this is a bullish market, it went down below that particular candle. You're seeing a wick here, but when you go to a lower time frame, this is not a wick, it's a lead low. Let me show you. Let's go to the 1 minute time frame for clarity. I like doing clear things. This is the structure. This is the wick of that candle. Look here, the wick. You see this low, this low, it's the one that has been represented by that particular wick, this low. And in this particular case, it's an external range liquidity. It's external, but when you go to 15-minute time frame, it's a wick. Okay, that's a wick. That's why you are told never trust the lower time frames. Why? The lower time frames, we always lie to you. They'll always make you take bad trades. Why? They form internal range liquidity of lower or of higher time frames. Lower time frames always form internal range liquidities of higher time frames. When you come to 15-minute time frame, you'll note very clear that that particular price action is the weak. It's the weak. So for you to trade, you are waiting for liquidity to be collected below this week, which is also external range liquidity on a lower time frame. I think we are together now. So when this candle drops below the previous candle, you just come and mark its low. That's now your liquidity points. It's your liquidity point. Why are you doing this? You are doing this to reduce the noise from the lower time frames, because the lower time frames will just give you form of fear of missing out and force you to engage in taking wrong trades. And then you just wait for the sweep. Okay, you're waiting for the sweep, and after the sweep, the structure that the market is going to give you, it's either it gives you two structures. Number one, the market can come and sweep here and give you the breakers, a break of structure in the same direction the market was moving. That one, that's a break of structure in the same direction. Again, the market can just come and drop to these particular lows. It can drop here and give you what that will be now a market structure shift, and you are safe. Why? You didn't check on the lower time frames. You are patient, so you waited. Meaning, the people who used the lower time frames, demand and supplies, they already took trades, but you, because you are clever enough, because you are competent to your entry criteria, you never took the trade. So any structure that will form, you are well with it. You know that the market can come and drop to this low, and you look for sales, or come sweep here and then continue to the same direction, and that's our anticipation, and take some buys according to your entry criteria. So in this particular case of ours, it gives us a break of structure to the same direction. Okay, when this break of structure happened, you see this particular red candle. Which one? This particular one. This particular red candle. That's a valid order block. What are the qualities of a valid order block? A valid order block must have or should sweep liquidity. How? It should have gone below the previous candle and swept. That's a characteristic of a valid order block. And remember one thing, a valid order block, it's not only an order block, rather it's also a demand zone. So this was a 15-minute demand zone. Okay, it was a 15-minute demand zone, that particular order block, and you should trust this zone. And this zone, it's very rare that this zone will end up lying to you. It's rare. Okay, so from this particular zone, it was a buying zone. Okay, it was very fair. Okay, it was very fair for you to take some buys from this particular point, and not something. The market rallied to this point, dropped here, and then rallied here and came there again. What does this mean? This is the demand zone. It's a very trading zone because we are trading after a sweep of liquidity, and the market rallied. Now, there's something else that I had said that I'll talk about. I said I'll talk about fair value gaps, mitigation blocks in collaboration with market structure. Because I, 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 I don't know if you have noticed something, that the market structure is changing, and the market it's not like it was before. Like, you see a lot of fair value gaps not being observed by the market. That's a reality. It's not about guesswork. But again, let me give you a secret. You can live in this particular chart but not find an entry. Why? Look at this price action here. Look at this price action from here. Yeah, from this demand here. That's let's just call it price action. No, let me show you. Look at price action from here to here, and let's call this price action 1. Yeah, let's call it price action 1. So that's basically our price action 1. And then look at this particular other price action from this particular point to this particular point, and let's call it this price action S2. And then look at price action 3, which is from here to here. Check, I said here to here, to this candle. Okay, that is now our price action 3. Those are 3 different price actions, and they are telling 3 different stories. If you want to be profitable, please check on the market structure. Market structure is the context. It's everything. It's the king in this game. And then check on these candles that were printing in one. You can see that this candle red, it went high, this one dropped, this one dropped. By this candle dropping below the previous candle, sweeping the previous candle, that's a sign that there's an internal liquidity generated, and the market is planning to come and sweep it later. This particular week, that particular week, that's a story. The market is planning. The market has a plan of returning to sweep later. Okay, that's number 1. It came and swept here and then rallied. Yeah, after that, you know something, we had a break of structure here, and then the market rallied and rallied and rallied. But again, you know something, come to 30-minute time frame. I want to show you the reality or the logic. Look at 30 minutes time frame. This was price action 1, this is price action 2. In price action 2, this structure, the whole of this structure, that one was also a pullback. Why? It went below the highest candle. The highest candle in this particular price action was this candle. So the moment it dropped here, it meant the market had a plan of returning here and sweeping here. Okay, that's price action 2. Let's go to price action 3 in 15-minute time frame. This price action 3. So here the market have swept all the inducement. They have swept the first inducement, the second inducement. So basically now here we are starting a new structure. Okay, we are starting a new structure. If you are starting a new structure, look here. Wave 3 went high. No candle swept the low of the previous candle. This was a strong rally with a lot of momentum up to this highest. Yeah, that one. And this one gave you a sign, or it told you something. The market is not planning to come back. Why? There's this particular fair value gap. That one, that's fair value gap 1. And this candle closed here. Okay? When that candle closed there, a good citizen or a person who understands the market structure could have just taken a long position here. Why? There's no any sweep of liquidity. There's no liquidity that have been engineered down here. Why? Because there's no a candle that swept the low of the previous candle. Most likely, the price is likely or willing to go up or high. Okay? Until we have a candle sweeping the previous, that's now when we know we have exhaustion of momentum. Okay? So a person who understands the structure could have just taken a buy from this particular price point and then long their positions. Okay? Very easy. It's very easy. You just take a buy position from that particular point and hold. It's risky if you don't understand the market structure. Again, we had after that fair value gap, we had this another fair value gap. That's another fair value gap. And again, as a good citizen, I have to look down from this fair value gap. Do we have any induced liquidity? Because inducement is basically liquidity. Down here, I don't see any. So basically, I'll just have to long my position because there's nothing that the market is planning to come and take here. These are void. These are liquidity void. No liquidity. There's no left liquidity. So we are gonna long and keep longing. That's market structure. That's how the price moves. So again, when that particular printed, you could have just taken a long position from that particular candle. You are not waiting for a fair value gap or something. You just take that a buy there. It's like a breakout or something of that sort or something, but it's kind of that. But again, you know something. After this one, we had this candle closing below this particular candle. Yeah, it closed below actually. You can clearly see and tell that it closed below the previous candle. Well, look here at this particular level. This the body of this, is the body of this. Okay, these candles dropped because this is the highest candle. They dropped here up to this particular point, and that was a really good sign. Stop buying the market. Stop buying the market. So anyone who entered even here is still in profits. They are still in profits. And the market have told them, we have swept these particular lows. So now we are planning to come back to sweep these liquidities, because that's basically liquidity. Okay. Now, whenever you see this break of structure, a break above that particular high, that's a break of structure. Basically, the lowest point that was formed during the pullback is here. That's your inducement. So this was the liquidity. That particular one, that was the liquidity. And now we just come and mark this particular zone as that's our liquidity point. It was our liquidity in this particular price action. We know that the market is planning now to come and take out this liquidity. Either it take out and come give us a market structure shift, a break of structure here, either a break of structure there, or a market structure shift. Okay, so the market came. This is an internal market structure shift, and it's not among our concern. Our concern is in this particular liquidity. How will the market sweep it? Will it sweep and reverse or close? But the market came here and closed here. When the market closed here, I noted something. During this drop, during the drop up to here, did we have another bearish inducement? Basically, we had one. Which one? We had this one. Yeah, we had this one because this candle swept the previous candle's high, because that's a bearish market. And the market came here. Now, after reaching this particular lows, it gave us, first of all, here, it gave us the inducement, then dropped. Remember, it hasn't collected our liquidity, and then dropped again here, swept our liquidity. We were very sure our liquidity is now here. We have closed by a body. It's a change of character to selling from buying. Now we are looking for sales because the market structure is saying sell. Okay. Now we'll be waiting to collect this liquidity that is lying here. Okay. Collect or close above or sweep. Then we swept the liquidity here. Okay. That's one thing. We swept the liquidity here. And when we swept that particular liquidity, we have, look here, there was no liquidity from this particular range, from here to here, no liquidity. There wasn't liquidity. There wasn't any candle that swept the previous candle. That one you can see, and you can narrate very clearly, because these candles were dropping. Because of that, I was very eager to take a short position from these particular order blocks, these particular fair value gaps. Okay, from those particular fair value gaps. After the sweep, now this is where we have liquidity and we have a bearish fair value gap. So the best thing was to take a short position there. Okay, take a short position and trade from that particular zone. And this price again, it's revisiting the same particular point. Remember, we also have the whole of this zone is a supply zone. Okay, this is a supply zone, and there's something that I thought Isaac can remember, Samuel can remember. I taught something called the consequent enrichment, which is 50% of a premium or a discount, whereby you can opt to trade from the most premium or the most discount by using the 50% of a zone, the highest or maybe the lowest according to the market you are, and enter from it. So In this particular case, you could just have decided to enter sales from this particular point there, and you short your position. So that's basically what we were to learn today. A question, because we have 1 minute before the meeting ends. A question. So like silence means there's no question. Look at the drop, how it's happening. That's now price delivery mechanism.
Today the knowledge seems to be flowing very nice. Can we continue? Can you open another one so we continue a little bit? Kindly.
That's just 1 minute because we are using Zoom and time is only limited for 40 minutes. We have just 1 minute and 7 seconds. So we can't start unless we do it tomorrow.
Yeah, I was requesting if we can open another session for some few minutes. We do the recap and the finalism.
Let's see. Is it okay? Okay. So
Pardon?
let's do it tomorrow. Tomorrow, please.
It's okay. But thank you so much for this knowledge.